Hello and welcome to CMC Markets Trading Outlook for the week of September the 21st, 2015. My name is Colin Szynski, Chief Market Strategist. My topic this week is what the game-changing reaction to the Fed decision could mean for trading in world markets over the next few months. The market reaction to the Fed decision has been very mixed, and I think there's a real change going on in the way people are thinking and approaching Fed signals on monetary policy. And basically, what I'm saying, starting with this, is that for the last 5 years, 8 years since the great financial crisis, the market has generally reacted to anything that comes out in terms of data or comes out in terms of speeches or decisions from the Fed as liquidity is good and tightening is bad. So what we've seen as during times when the data was bad or the Fed stays dovish or anything pointing to a dovish Fed has sent stock markets screaming higher and U.S. dollar down because, of course, by things like printing more money, such as QE programs, depresses the value of money. Now, this time out, we've seen something very different. We saw the Fed take a more dovish stance than people had expected at the September meeting, and instead of going up, stocks have gone down. Instead of going up, commodities have gone down. The U.S. dollar has gone down as was to be expected, but there's a real game changer going on here and a real change in how people are approaching what the Fed says and what the Fed does. And the reason for this is that the U.S. economy is generally improving, and I think there's a recognition of that overall. And in a normal cycle, we're getting to the point where central banks would start raising interest rates to want to get ahead of the curve, to not want to fall behind on inflation. And the Fed itself has said many times they want to take a steady, measured approach to how they go about raising interest rates. They don't want to do the aggressive hike campaigns of the past. They want to just take their time and do it in stages. So, but what we've seen at this meeting is that the Fed came out more dovish than people were expecting. Now, my feeling was, and I'm not totally surprised at how this meeting went. My feeling was, and if you'll recall my video from last week, that I was saying that the Fed would probably not raise interest rates, but that they would signal towards a rate increase in October or December. That I think they did. They didn't raise interest rates as we thought. I think September was a little too soon after all the market fluctuations of August and the volatility and the uncertainty about China. They got two more meetings. There was room for the Fed has room to wait a little bit and make sure things are settling down. The second thing was, however, that I said they would signal towards a rate increase, and that they did. They raised their GDP forecast, they raised employment forecast by cutting their unemployment rate forecast, and we had a hawkish dissenter. So all told, those things were definitely still pointing towards a rate hike later this year. I still think October. On the other hand, though, there was some more dovish indications, and I had also suggested that whenever the Fed does move to raising rates, they would probably offset that by going dovish in their commentary, and they did go dovish in their commentary, but more particularly we saw it in the plot of Fed member expectations that they came down quite a bit, and one of the members actually went and started forecasting negative interest rates, which I personally think was a red herring, and I think they went a little bit too far, and I think we're seeing that in the market reaction today, that the Fed has probably gone a little bit too far in trying to stay on to talk dovish at the same time as signal hawkish, and I think it's backfired on them. I think it's created a lot of confusion, and because of that, we're seeing the reaction in the markets that we have. The reaction we have had in the markets is that we've seen a sell-off in the U.S. dollar, major rallies in all the other currencies led by gold. That's to be expected because I think the markets had basically priced in that the U.S. would start raising interest rates back in March, and that they would then go on a relatively regular campaign of interest rate increases. It's become increasingly clear that that's not going to be the case, that it's been delayed quite a bit, and that the path upwards is not going to be as steep as people had thought. What are we seeing? Bang, the U.S. dollar is coming back down. That's to be expected. Where we're seeing the game changer is in stocks and commodities. And I'm just going to show the chart for the NASDAQ 100 first, and then I'm going to come back to gold a little later in this presentation. We'll start here, and what I wanted to highlight with the U.S. dollar, and actually it looks even better on the NASDAQ, here is we've had a major reversal. We've had markets steadily recovering. Things have been looking pretty good of late. However, now we're seeing a real significant technical downturn in the markets. And what's happened was that in the past, people would say, okay, great, dovish Fed, happy days are here again. Fed keeps on stimulating, great for the stock market, great for the economy. The problem this time is that because people have been expecting that the Fed is moving towards raising rates, and pardon me, this is the meeting where people have gone, oh my gosh, well, what do you mean they didn't raise interest rates? Well, what does that mean about the economy? Maybe the economy's not as strong as people think. What about China? They've talked about overseas problems. Is China weaker than people think? What does that mean for resource demand? What does that mean for corporate earnings? Oh my gosh, are we sliding back into a recession before the Fed's even had a chance to reload? And those are the kind of things where all of a sudden the dovishness is starting to go back the other way. It's coming back to haunt them. I had warned in my FOMC written preview about the potential for a negative signal being sent, and certainly it looks like stocks and commodities have taken the dovish Fed, or the overly dovish Fed really, as a negative signal, and that's what we're seeing today. And we look here at the Nasdaq in particular. We had this beautiful ascending triangle base forming here. What did we see? Spike above the 200-day, spike above the 50-day, slammed back down. This is almost a gravestone doji, and it's a very, very bearish one-day candlestick signal. On top of this, we had a rally. This is almost an evening star, bearish 3-day candlestick signal. We've got the RSI starting to roll over as well, although it has not cracked back under 50 yet. And if I draw in the trend line here, we'll see that this nice ascending triangle base that had been forming has now failed. So what does that mean? It means we're probably heading into a time where things could be weaker. The uncertainty over what the Fed's going to do and when continues. We're still working our way through the weakest time of the year for world stocks, and it looks to me like we could be in for a down leg here. And something to remember is when we go back to 98 and 2011 and some of the other big summer sell-offs, we often had a sell-off in July or August, a rebound, and then a retest into late September, early October. These technical failures here of bullish patterns not only coming to completion but actually being rejected and going back the other way suggests, and the Fed now holding off, suggests that we could get a retest of these August lows for U.S. indices and for European indices as we get into September, early October, which is something I don't think they wanted to see. I think the Fed went dovish to kind of keep support for the markets, and instead it's gone back the other way and it's sent the markets back down. So that was the Nasdaq, and I'll also show the S&P as well. Here we go, and the S&P, same thing. This big run up above the above 2,000 and a failure. Failed to hold. Again, not quite a gravestone doji, but still pretty ugly candle here. Not quite an evening star, but certainly not very encouraging technically either. The ascending triangle in the this is actually the Russell. In the Russell has not failed yet, but whether it's the Russell or whether it's the S&P, we got a lot of these bearish reversals yesterday. We had bull traps, we had buying climaxes, we had things getting above moving averages and resistance levels and failing huge. So we've seen a real game-changing shift in sentiment and a real change in the way that traders in stocks and commodities are approaching news out of the Fed. The bad news is good news days are over. Now we're into the bad news is bad news and good news is good news. So something for traders to recognize now. That's the point we've reached in the cycle. So on that note, I'm going to shift back over to currencies, and I do want to bring gold back up. Actually, before I do that, I will do crude oil. Because crude oil is now falling, same thing. We had it here. It was going along pretty good. It's still basically base building between 43 and, well, we'll call it 49 up here. Maybe here, really 47.50, let's call it, here in this channel. We were getting up to the end. Look at this. We broke a bearish descending triangle. We caused that to fail. Good news. Look at this. Really nice breakaway move here. Very good. But now we're seeing it roll back. Now, so far, this is consolidation. But if we start to see crude oil slip back under 45, then we could see a retest of the channel low near 43, perhaps even a retest of the August lows, or is back near 37. There's the 40 round number here. Also keeping an eye on the RSI on crude oil, because so far it's clinging to 50. That keeps this uptrend intact. That's good news. If we do see 50 start to get breached, would suggest we could be heading for a more significant downturn. I'm going to move over now and start talking about currency markets. We could be in the middle of a big currency trend change here. The U.S. dollar Fed march towards higher interest rates has driven the U.S. dollar substantially higher over the last year. That now appears to be breaking down. People seem to be coming around to this idea of the Fed's not going to move as fast as people wanted initially, and the Fed may not move up as fast as they have in previous cycles. So I'll start with gold here. Another big breakout for gold. Look at this. So we had a fairly significant move up here in gold. It broke this 5-month downtrend back here, but it wasn't able to hold, and then it slumped back down. And here at the time, this breakout had coincided with gold getting fairly overbought. So that was so we did have a failure there, and it came back. But look at this, supported a higher level instead of bottoming out at 1080 and people worrying about 1,000. Look, it bottomed out at 1,100. That's a higher low. That's good news. Confirmed by a higher low in the RSI. That's good news. Gold is now broken out of this trend line again and has not been smashed back down yet. And we're getting this confirmation here from the RSI back above 50, signaling an upturn momentum. So we're looking at a weaker U.S. dollar. One beneficiary in the near term looks to be gold. We talked about indices retesting their August lows. Gold could retest its August highs here. This is 1160, a Fibonacci level, and this peak here was a lot closer to 1170. So there is room for some significant upside in gold. Well, I'll also note here that we saw some good interest coming back into some of the commodity currencies as well. So we'll start with Aussie dollar here as an example. Here's another one that is starting to break out of a downtrend. It's broken out, and it has been retesting the breakout point as new support. RSI above 50 and rising here. So the Aussie dollar is back above 72. This resistance here was 73.74. This previous zone of congestion here, but it looks as though we're starting to climb out of a bottom for Aussie dollar. Another significant one is Canadian dollar, and I know we all trade US dollar CAD, but I'm going to show CAD US dollar to highlight the turn here. Look at this. Big downtrend for along with the oil prices for downswing in Canadian dollar. Look at this, so nice positive divergence in the RSI over the last few months, holding 75-cent round number held. A couple of bear trap dips under it, but 75 held. Really nice base. Now it's starting to break out of this base above 76. Next resistance about 77.20, then about 77.70. We'll move on, and I'll show euro dollar. Eurodollar, amid all the crisis in Greece in the summer and everything else, the worst of it seems to have hit back in the winter time. There's a double bottom here back March, April, moved initial rally going sideways. But look at this, higher lows all through July, August, and into September. After the Greek referendum, the euro's actually been working its way higher, confirmed by generally higher trending lows in the RSI. And let's keep an eye on the moving averages here. The big spread between the 50 and 200 day is slowing, and we're getting close to a golden cross, which maybe we'll get towards the end of the month if things continue the way they are, where we could see the 50 crossing back above the 200. We talked about the death crosses earlier this summer in the DAX and the Dow and other things, and then those led to some fairly significant declines. If we get a golden cross in euro dollar, would be a significant change in terms of trend, that we've gone from a strengthening to a weakening US dollar, gone from a weakening to a strengthening euro. That's significant. Keep an eye on that over the next few weeks. Well, let's take a look at cable as well. Cable generally has been strengthening. People have still in the feeling that once the Fed raises interest rates, the UK might not be too far behind. We've had a pretty good upswing. It's a wide channel here, 152 to 159. This middle Fibonacci here is about 155.80. We've had a nice rally up off the lows. We're pausing here into the weekend, but basically it looks as though it wants to work its way upward. We're getting support from the RSI. As well, and I'm also just going to show the Kiwi dollar here, and we're seeing the decline. There was a big downtrend in Kiwi dollar, and also at the same time we're seeing this start to bottom out here in the 62.50 to 64 ranges, trying to break out here. We'll see it's certainly showing at least signs of improving support. And for dollar CAD traders, I will just show this one here, which is the other side of the CAD dollar. I talked about the CAD dollar base. Here's the US dollar CAD peak. Look at this momentum got really overbought by July. Negative divergence, lower highs in the RSI, higher highs in the pair, ran into resistance here about 133.40, then 133, and it was starting to fall. We've got I'll show this trend line here. That's now been broken. So we had an uptrend line here. That's pretty much now being broken, and now we're starting to see it fall away, and we're also seeing that confirmed here by the RSI dipping below 50. So we're definitely seeing, and this is a good example here of rolling over U.S. dollar. I'll also show dollar yen as another example here of how the U.S. dollar looks like its trend is topped. Here we had the initial sell-off back in August. It's consolidating at a lower level, but basically still looking like it could weaken with lower highs there, and the RSI rolling over under 50 over here. The other thing I wanted to talk about was China very briefly, and I just want to show the Hong Kong markets for a minute and something brief. The Fed expressed concerns about China, but in my opinion, I think the worst is behind China, and that is starting to stabilize. And look, this is the Hong Kong China H shares. These are mainland companies listed in Hong Kong. The massive sell-off May to August, but look, we've got a double bottom now. This is starting to work its way up. We're seeing this big downtrend here has not been broken yet, but we're getting awfully close. RSI has not been breached yet, but we're getting close. We've got nice base building underway in China. Maybe we get a pull back into here, form a head and shoulders bottom, but it does look as though China's starting to bottom out here. And if we show this on the Hang Seng as well, seeing the same sort of thing, a double bottom here, nice base forming, ascending triangle, RSI momentum support. RSI has already broken a downtrend, trying to peak above 50 and confirm the upturn. But basically, so China had a double bottom here in August, September. We've seen an August low in the in European and North American markets. We had a bigger rebound. We may yet get a retest in August, September. The important thing is looking forward now that the Fed does still appear to be on track towards raising interest rates. In fact, at her press conference, Fed Chair Yellen did indicate that they could raise rates in October, and if they did, they would call a press conference on short notice. So the other thing, I think that the negative interest rate call for the U.S. was a red herring. I think that was to show some dovishness. I think they went a little bit farther than perhaps they should have, and perhaps they had intended to, giving the reaction of the markets. And why am I talking about all of this? Because going into next week, it's a fairly light week for data, but the talk is going to be dominated by a number of Fed speakers. On the weekend, we have Williams and Bullard speaking. We have Lockhart speaking 3 times, and we have another speech from Fed Chair Yellen, and later in the week, Bullard and George. So several Fed members are speaking. Also speeches from Bank of Canada's Paloz. He's talking in Calgary. I'm sure there's going to be a lot of questions for him about what's going on with the Alberta economy. We have Draghi from the ECB speaking as well. So there's a lot of central banks out there. The only real economic news we have that might get attention is the flash purchasing managers reports from around the world give the first indication of how things are going into September now that we're out of the summer and past Labor Day and all the other holidays. We do have a U.S. GDP update, but since it's the second update, I don't think people will put as much stock into it unless there's a major surprise. It probably won't cause too many waves. But with all the reaction coming out of the Fed, this change in sentiment and how the market is reading what comes out of the Fed could be particularly significant as Fed members speak throughout the week.